Hello, and thank you for joining us for this month's Kapnick Drive webinar, Demystifying Credit Scores. Today we'll talk about what a credit score is and how your health can be impacted. To begin, let's determine the differences between your credit report and your credit score. Both are tools used by lenders to measure your credit risk, which is another way of saying the likelihood that you'll pay your bills on time. A credit report is used to determine your credit score. It includes a detailed history of your credit, including the types of accounts you've had previously and your borrowing and repayment behaviors. Your credit score is derived from this report and is utilized by lenders to determine credit worthiness based on predicted risk. This is important as it is reviewed when obtaining things like a mortgage, credit card or credit limit increase, auto loan, and more. It can also play a factor in determining the interest rate you will pay. In other words, you can think of your credit report as your report card and your credit score as your final grade. Your credit report is a statement received by furnished lenders or companies that request your credit report that has information about your credit activity and your current credit situation. Each year, you can request a free copy of your credit report by one of the 3 nationwide credit reporting agencies, which include the Equifax, Experian, and TransUnion. We'll talk more about why it is important to check your report at least annually later. Your credit score is an instantaneous look that can tell lenders how much of a risk you are to them if they were to offer you a line of credit. There are a lot of factors that can impact your credit score down to the time of day that it is checked. Higher credit scores mean lesser risk to the lender, and therefore you are more likely to be approved for a loan and potentially receive a lower interest rate. So now that we know the difference between your credit report and your credit score, let's dive deeper. What is the importance of these? What is the real-life impact? And why should you care? Your credit score is calculated using scoring models such as FICO and VantageScore. These scoring models are used by lenders to evaluate credit worthiness. They both range from 300 to 850 based on credit bureau data. FICO is the industry standard and heavily weighs payment history and extensive credit history. VantageScore is often used for educational purposes and is better suited for providing a consistent score across all 3 bureaus. The average American FICO credit score is 715, and the average Vantage score is 702. If you're not sure what your score is, now is a great time to check. I will provide more resources on how to do so towards the end of the presentation. But the higher the score, the better the rates you will receive. If you have a lower score, you may be denied a loan or even have additional fees associated with any approved loans. The items that influence your credit score from FICO and VantageScore include payment history. This makes up 35% of your FICO credit score. It includes all the details on whether you have paid your past credit accounts on time and gives insight to the amount of risk the lender will take on. The amount owed accounts for 30%. If you are using a lot of your available credit, this may indicate that you are overextended and therefore at a higher risk of missing payments. The length of your credit history also impacts your score, making up for 15%. Your oldest line of credit is important as it shows how long you've been managing your finances. If you can, keep it open even if it receives minimal utilization. Credit mix accounts for 10%. Examples of credit that are included here are credit cards, car payments, home and mortgage payments, retail accounts, and more. Another 10% of your score comes from new credit. Limiting the amount of times you apply for credit is beneficial because if you start rapidly applying for cards, companies and lenders are going to look at that as a sign of financial distress. Other factors to watch for are your debt-to-income ratio and your available credit. The debt-to-income ratio is how much debt you have versus how much you bring in to be able to repay your current debt. And your available credit is the percentage of credit you have available to you, as well as the amount you use. Experts recommend keeping this around 30% utilization. There are many benefits of credit utilization when you are smart with your spending. Having a good credit means you have more buying power, and it makes it easier to get approved for loans and credit cards. It can also help with financing big purchases, such as buying a car or a home. Credit companies often offer cash back and travel rewards for programs based on utilization, which then rewards you for appropriate spending. Oftentimes, credit companies will offer promotional periods as well. They will offer something along the lines of 0% interest for 12 to 24 months to help you grow your credit history. This can be a good way to start building credit as there is less risk. However, you have to make sure that you are able to pay back the amount you borrow before the promotional period ends to avoid accruing interest. On the other hand, as always, there are risks associated with credit and credit scores. The biggest of these risks is obviously getting in over your head and overspending. High interest debt can quickly snowball and becomes more difficult to pay off. If you carry a balance, you'll pay significantly more than the original purchase. Because late or missed payments can hurt your score, there is a lot of pressure to maintain where you're at. It takes time and commitment to rebuild once it is damaged, but it's not impossible. As previously discussed, your credit score is based on a variety of factors, and it is not always transparent and intuitive, which can make it difficult to understand. The bottom line is that credit itself is neither good or bad, but it's a tool that should be utilized responsibly to open doors and save money. If misused, it can lead to long-term financial stress. We've now broken down the difference between your credit score and your credit report. Now let's talk about who has access to these. There's a wide range of companies that can view your report. It includes groups selling mortgages and car loans, employers in a background check, landlords during a tenant screening, banks, credit unions, and merchants that accept personal checks and electronic fund transfers, as well as retail stores who have their own financing. You're often not notified when a company is checking your report, so it's important to make sure your report is staying accurate. However, if you are aware, then according to the Fair Credit Reporting Act, all consumer reporting companies are required to provide you a copy of the information from your report if you request it. Did you know you're actually entitled to one free credit report per year from annualcreditreport.com? It is important to make sure these are accurate to ensure you have the best possible credit for your situation. There are 3 methods of requesting a copy for your report. You can request a copy online, via the phone, or over email. If you need to monitor closely, you can request the reports one at a time using a different method every 4 months. If you do this, then you can receive 3 reports in 1 year for free. And in 2019, there was a settlement that resulted in all U.S. consumers being able to request up to 6 free copies of their Equifax credit report during any 12-month period through December of 2026. These are in addition to any free reports which you are entitled to under federal law. If you're just getting started on your financial health journey, it may be a good time to check multiple times throughout the year. You can use your phone to scan the QR code to register with Equifax and request these copies, as December 2026 is quickly approaching. After obtaining a copy of your report, either from one of the resources on the last slide or requesting a copy of it when it is reported to a lender, you'll want to review and check for any errors, because they can happen. Possible errors may include identity errors such as your name, phone number, or address, accounts that belong to someone with a similar name as you but it's listed under you, or incorrect accounts resulting from identity theft. Other types of errors may come from incorrect reporting of account status showing open accounts when they should be closed, being reported as an account owner instead of an authorized user, incorrect payment posted dates, or the same debt listed multiple times. If any of these errors or other errors are identified, your first step is to contact the company that sent you the report and the lender or company that provided them the information. After that, you should contact the nationwide credit reporting companies, so Equifax, Experian, and TransUnion, to report the potential error and explain what you think is wrong, why, and include supporting documentation. The report you are provided with will also contain instructions on steps to take for disputing any errors. With all of this in mind, let's talk about the impacts your credit score and your financial health can have on your overall well-being. While it may not seem obvious at first glance, your financial health is tied to well-being, from your mental health down to your ability to get care for certain conditions. Financial difficulties can often cause stress, and there is a stigma around debt that limits individuals from asking for help. Instead, they may apply for more credit and max out additional cards, resulting in lower financial health. The impact of financial difficulties can also lead to cutting back on essentials such as eating and household utilities, including heating and air conditioning. When this happens, it is also harder for individuals to engage with essential services such as banks and energy companies due to generalized anxiety, leading to a racing heart or difficulty breathing. Adding to the cycle on the previous slide, there is also a large income gap for those with mental health problems, and individuals dealing with mental health problems are overrepresented in lower paying positions. Mental health problems can come with increased impulsivity and forgetfulness, which may result in overspending and the inability to stay on top of financial management. When going through a period of poor mental health, 63% of people found it harder to make financial decisions, and 42% put off paying bills. Additionally, if individuals are unable to attend work due to acute episodes, they may have difficulty holding down a job or becoming benefit eligible. Without health insurance, it can be seemingly much harder to seek out care from a medical professional, but there are many free resources available, which will be discussed shortly. Credit scores may be predictive and help us understand who is more likely to develop, treat, and manage a condition. Although having poor credit does not necessarily cause poor health, there could be key associations to identify, such as whether patients who are frequently late on their payments also struggle with medication adherence and follow-up care. Now, the big question becomes, what can I do to improve my credit score? The first thing is making sure that you are staying on top of any errors so that does not have an impact on your score. Assuming there are no errors, you'll want to ensure you are meeting all of your payment deadlines. Setting up auto pay or creating electronic reminders is a good way to stay on top of due dates. To keep average daily balances lower, it can also be beneficial to pay down the balance in the middle of your billing cycle. This can also help digest larger one-time payments. Experts recommend trying to keep your credit usage to about 30% of your available credit. The amount of credit you use impacts your score and the amount of future lenders are willing to give you. For a quick increase in your credit score, pay down all credit card balances to below 10% utilization. So if you have a $10,000 credit limit, you'll want the balance to be below $1,000. You can always request a credit increase, which can assist with not going above that 30% utilization. Another factor that is considered when calculating the score is how old your credit is, or when you opened your first line of credit. The older it is, the better, as you will have a more established record. As previously mentioned, you'll want to keep your oldest line of credit open for as long as possible, even if it does not receive much utilization. Another step to take is to make sure you are only applying for what you need. If lenders see that you have applied for a lot of credit over a short amount of time, they may assume you are dealing with financial setbacks and will be less likely to approve your credit request. You can also build credit by becoming an authorized user on a trusted person's long-standing low balance account. Lastly, Experian Boost is a free tool that adds on-time utility, phone, and rent payments to your credit file, which can instantly boost your credit score. Before we go, we want to provide you with a few resources that are available to you. As I just discussed, using the Experian Credit Boost is an easy way to improve your credit score quickly by adding positive, on-time, and non-traditional payments to your credit report. This typically covers the last 24 months of payment. We also discuss the correlation with financial health and mental health, so we want to provide a mental health resource as well. MindShift CBT is a free evidence-based app designed to help manage anxiety using scientifically proven strategies based on cognitive behavioral therapy, or CBT. It includes guided tools for working through worry, panic, and avoidance. This helps users respond to anxiety in the moment rather than only tracking it afterwards. Users may share their progress and data with their providers as well. The Consumer Financial Protection Bureau offers a large variety of resources for individuals wanting to learn more about their credit score and reporting, as well as resources for buying a house, getting an auto loan, planning for retirement, and more. If you're not sure where to start, using that QR code or that link would be a good place. Now, as we wrap up today, I want you to leave you with a question to ponder. What is one move you could make today to work on improving your financial health? We want you to take this journey one step at a time, as little adjustments can make a big difference. Thank you all for being here today. We hope this gave you a clearer understanding of credit scores and reports and the role they can play on your health. If you enjoyed today's webinar, we have another one coming up on May 27th. We'll be talking about hormone disruptors, what they may be hidden in everyday products, and how they can impact your health. You can use a QR code on the screen to register if you'd like to join us. And if you're part of Strive, don't forget to log today's webinar for your reward points. Thank you again for your time, and I hope you have a great rest of your day.